how do we do it? How do we think, if market timing doesn't work, and hopefully I've convinced you of the challenges of market timing, how do you do it? Well, we believe in rebalance from time to time, and it's a more disciplined approach. So we've had a lot of people over the last few weeks ask us in Q&A, well, isn't that market timing? No. So, for example, we did a study, and we presented this study, I think, last year in the seminars. Let's say if you take the GFC, coming up to the GFC, so we had a look at a balanced portfolio over the last 20 years. And what we did is we only had to rebalance 4 times. So when you use the portfolio manager, again, it's free. You put in all your investments. It tells you your sort of asset allocation across the different asset classes. So it even looks into your managed funds and into stocks and goes, right, well, that's an A REIT, so that's property. Even though it looks and smells like an Aussie equity, we go, that's an A REIT. We look into your funds and we go, right, well, you've got a little bit of exposure to international. We add all that up, put it in a pie chart. We compare that to your risk profile that you choose. We even last year introduced your own custom asset allocation. So if you don't like our asset allocations, you can actually choose your own, and you basically monitor your portfolio against that sort of set asset allocation. What we found for a balanced portfolio is we only had to rebalance 4 times over 20 years, and we increased our returns by about 1%. And how it happened was, think about balance, you sort of 50% in, let's say it's 50% in equities and 50% in fixed interest in cash. When we were starting, and let's say you started off in early 2000, so you started off in early 2000, as the market actually steamed ahead in equities, you were getting further and further out of whack with your risk profile. And so our HealthCheck score continually goes down from 100% to 75%, and once it got under 75%, we went, right, rebalance. It only happened 4 times. So in 2002, it happened. In 2006, it happened. In 2007, we had to move. And so what I mean it happens is the HealthCheck score, our equity exposure, got bigger than what we actually, our risk profile suggested. So we took some risk off the table and we moved from Australian equities and international equities into cash. We did that in 2006. We did that again in 2007. Everybody goes, but that's market timing because then it crashed. No, we weren't even looking at prices. We were looking at our exposure to that asset class. So it had nothing to do where prices were going to go. So in 2006, we didn't go, oh, the market's going to crash. We're going to take some risk off the table and put it into cash. It was just that our risk allocation was more in Australian equities and international equities than what we actually required from a risk profile point of view. Then the market kept on going, and we did it again in 2006. Then the interesting thing happened. 2009 was the low of the market, and our HealthCheck said, well, now you've got to take money out of your cash because now you're overweight cash and underweight international equities and Australian equities. And so we moved money from cash over to international equities and Australian equities. So it's got nothing to do where we think prices are going to go. It's got to do with the fact that where your exposure is and making sure that that's in line with whatever your risk profile is. So if you remember what happened in 2000, everybody was flying high. 2006, everyone was doing high fives. You probably doubled your money. And then everybody was crying in 2007 and 8 and 9 thinking, I lost half my money. Well, the problem is you were greedy. And you kept on thinking you're going to get 20% returns every year and it's going to keep on going forever. And your international exposure, your Australian exposure, your property exposure, which is happening now, even though we're telling everybody they're overexposed to property, we have been doing it for 3 years, you are overexposed to something, you've got to make sure it's aligned with your risk profile. So we don't think it's time in the markets, we think it's market timing. We think compounding interest, making sure your money is in the markets, making sure it's diversified across asset classes, making sure it's in line with your risk profile is the best way to make money over the long term. So we believe in also regularly and consistently contributing to your funds. Most of you here are probably in sort of like, retirement phase, but definitely for younger people, you should be consistently adding to your well-diversified portfolio. That's called dollar cost averaging. It's another way to smooth out volatility. And lastly, but not least, making sure you rebalance from time to time. You don't have to do it every day or every week or every month or every quarter because you're just going to chew up brokerage costs. We think when your HealthCheck gets out of about 75% alignment to your risk profile, you should be having a good look at it.